Welcome to Realty Mogul, the online marketplace for real estate investments. Let's talk about real estate investment styles. When we talk about a property fitting a certain investment style, we're basically talking about where that asset fits along the spectrum of potential risk and return. Using a set of defined terms to identify points along that spectrum helps to provide investors with a quick snapshot of a prospective investment's characteristics. There are three main investment styles into which private commercial real estate properties can be grouped: core, value-added, and opportunistic. Real estate professionals have also added another style, Core Plus. Core assets are the low-risk, low-return area of the spectrum. These properties are high quality, well located, and many times have long-term credit leases. Thus, investors in core assets can expect predictable and stable income flows with a high proportion of total return attributable to current income as opposed to appreciation. Think of a beautiful office building in Manhattan whose floors are leased to various big corporations and law firms. Investors in core assets are typically those who seek a more secure return that comes largely from ongoing current cash flow. Core Plus properties are next on the scale, with moderate risk and moderate return. Usually Core Plus properties are high quality, but could use some minor renovation or other form of enhancement to reach their full potential. That need for rehabilitation creates a little more risk and might require more financing than the traditional core assets, but at the same time, it's likely to increase the potential return. Maybe it's a luxury multifamily apartment complex in Los Angeles, where adding amenities such as a gym could allow the complex to command even higher rents. Buildings that require even greater levels of improvements or repositioning involve still more risk, but with more potential upside. These are categorized in the value-added and opportunistic asset classes. Value-added opportunities hope to achieve a larger percentage of their return than core or core plus properties from appreciation. These properties require some redevelopment, rehabilitation, remarketing, or other forms of property enhancement, which can significantly increase future cash flows and appreciation value, but which also involve relatively more risk. Value-added investors are usually willing to perform significantly more due diligence and to take on higher risk in exchange for enhanced returns. Think of a historic building with many empty units needing rehabilitation, which if done right could become a complex of luxury lofts. Opportunistic investments are expected to derive most of their return from appreciation and exhibit the most risk on the risk spectrum. This may be because the property needs to be redeveloped, is difficult to lease, or requires a lot of financing to make all of the necessary improvements. Think of an abandoned hotel in Las Vegas that could be rebuilt or significantly renovated, remarketed, and eventually become the new Wynn of the Strip. Opportunistic investors tend to be large, sophisticated investors who can provide the significant capital required to redevelop the property and who can afford to take the risk. Knowledge of the different investment styles allows investors to strategize based on their specific return objectives and risk tolerance levels. At Realty Mogul, we tend to focus on properties with at least some current cash flow. We think that this more conservative approach is appreciated by passive investors, and that in those cases where cash flow already exists, the appreciation potential should always be there.